Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for October 18th of 2021. Please see our disclaimer for important information. Well, as we get started this week, just want to recognize the fact that we did not have a Charts of the Week or Market Minutes last week. I was traveling on the road and not able to get those two things done. So we've got a little bit of catch up this week, and hopefully you'll enjoy the presentation. Got a lot of conversation about the equity markets, labor, inflation, and really kind of the state of the economy and our expectations looking into next year. But against that backdrop, let's take a quick look at the COVID tracker. So you can see here, bringing us up to date over the last several weeks here in October, we have a clear deceleration in 7-day moving averages of both daily new positive cases as well as daily deaths here in the U.S. per the CDC information that you see on your screen here. So we were worried about some false peaks, but I think it's a clear trend now that we're seeing in developing with regard to the virus. Now, the conversation now is shifting more towards boosters and whether or not to lower the age of those folks that are willing to and are able to take the booster vaccine. And so expect to see more developments on that front, as well as some additional developments on the vaccine front with regard to minors. Here's our high frequency data courtesy of First Trust. And really the key focus here as we kind of get into the last few months of the year is that change versus 2019 and that normalization phase. Again, I've always said that this data is a little bit noisy. If you look at the week over week data on the far right, the month over month data is a bit more telling. You might draw some adverse inferences if you look at the steel production number being down month over month, but the fact is the steel production year, basically relative to 2019, is positive. As you can see, all the red in that change versus 2019, those numbers are beginning to narrow a bit. We do see, like global commercial flights are still 20% below where they were in 2019 at this time. Supply of motor gasoline is almost basically where it was. TSA checkpoint data, we still don't have that, that recovery, which, if we go back to prior downturns, prior recessions, we know that takes a while. Open tables, hotel occupancy, same story there. We'll get there. It'll just take some time, and we'll have to be patient. Here's some of those charts, some of that high frequency data kind of visualized here for those that are more visual that's watching this. The hotel occupancy, you can see here, there are seasonal factors that are at play. We're not quite at 2019 levels as we saw in the last chart, but again, we're beginning to, show, I wouldn't say we're beginning to, we are showing a more normalized seasonal pattern in this post-pandemic recovery here. TSA checkpoint data, same deal. We just have less supply out there. We just frankly have less business travelers, and we know, as we've said before, that business travelers just take a while to recover. We know that there aren't as many conferences, things like that. We would expect to see that data improve in 2022. Open table, again, kind of the same story, but there is a little bit of a seasonal pattern with regard to open table as well. And motor gasoline, we've already talked about. Here's a quick check-in on global trade. And you can see this trend line that's established from 2016. And you can see the impact as we get into 2018, 2019 of some of the trade-related impediments that were put forth by both China and the U.S. in terms of tariffs, et cetera. And then we had the pandemic. So the global trade environment was weakening a bit anyway before we even hit the pandemic. And now we have recovered. We have eclipsed pre-pandemic levels, but we're still well below that trend that was established before we began to see some of the impact of those tariffs. Here's a quick check-in on imports into the U.S. So this is really a proxy for demand by the consumer, which really doesn't show that much of an abatement. If you look at that kind of the orange line at the top, that represents 2021, which, if you put that against the backdrop of the last 5 years or so, it actually looks very good. So demand remains high. We know that this has contributed a lot to the supply and container shortages and the supply choke points, as well as high prices for container ships that were in short supply, and driving a lot of the congestion in our transportation and logistics networks. Now we'll go ahead and transition into domestic economic issues. We'll start with GDP, kind of the overarching picture here. This is courtesy of our friends at FS Investments, but this is consensus forecast data that is derived by Bloomberg. And you can see here in the orange bars represents the look-ahead forecast. And this is something that we've been talking about for a long time, kind of this normalization of economic behavior down to kind of a level that we saw on average before the pandemic. And that's about 2.5% annualized growth, which is a solid level, not robust, certainly not reflective of the environment that we've seen over the last several quarters. But as you can see here, a lot of this is a bounce back and a rapid recovery from the shock that we had in the closures and whatnot. And so, you've got the law of large numbers here. And so when you had a large decline, you obviously had a bounce back. And now we're beginning to see that roll over into an area that I think is going to be the case for 2022 and perhaps beyond. So we'll go ahead and transition now into the labor markets. And we've got a lot of data here. We've got to kind of get us back up to speed where we are. So these two charts will look somewhat familiar if you've been watching the charts of the week for some time. Obviously, unemployment rate has come down. That's good. The equilibrium rate or full employment rate as defined by the Federal Reserve, you can still see that we still have a ways to go there, but we are trending in the right direction. That's good news. Bad news on the right-hand side is some of this is due to the fact that we've got a large drop in our participation rate. And this is a percentage of eligible workers in the workforce that are actually participating in the labor force. And you can see that that number really dropped off in the pandemic, but it hasn't recovered. And it's interesting, we have a slide coming up that will show you that it has a lot to do with certain age cohorts. So, and when you break down the age cohorts with regard to what's going on in participation, you can see that really the large crux to the impact has been borne by the 55 and older crowd. I mean, we had a large drop in those folks. Some of those folks just simply retired, went off the workforce. The pandemic shut their, basically took away their job or whatnot. But oddly enough, we have seen a little bit of a pickup here in 2021 in the participation rate for that older cohort, but it's still at a very depressed level. Now, if you transition to a younger cohort, kind of that optimum group, your peak wage earner group there, the 25 to 54 group, that remains relatively depressed as well. And really, the only group that you see kind of recovering in a meaningful fashion is the 16 to 24 age group. And those aren't the high earners, right? Those are high school kids with jobs. Those are college and postgraduate folks that are definitely participating in the market. But your higher earners and certainly your senior folks are not participating nearly as much as they were. And this has a lot to do with that lower participation rate. So we've talked a lot over the last several weeks and months, frankly, about the quits rate and job satisfaction. And I've been kind of looking for some charts that kind of tell that story really well. And if you look at that 18 to 34 age cohort, even though you saw in that last slide a much higher participation rate than you did for the older cohorts, you can see here that they're largely much more dissatisfied in what they're doing. And so you see a lot more volatility of labor in this lower age cohort, particularly here in the 18 to 34 range. These folks, you can see the satisfaction levels really going down. And a lot of this has to do with benefits and flexibility and things like that. And you can see some of that on the right. So when you kind of dice up the labor market by income and compensation, you can see that the bottom 25% of those folks, roughly half of them have access to paid sick days, which is a kind of a form of flexibility, right? You know, if they sick days, vacation, sick days is just one proxy here, but I thought it was kind of relevant because it does help to tell this story, because you've got the high wage earners, the high income earners, those folks largely have access to this and to a lot of other things, but it's the lower compensated folks that don't have access to a lot of these benefits, and it's creating a lot of frustration. You have a lot of people in the service industry that are, you know, witnessing more hostile work environments from customers, like in restaurants, that are mad because they've got to wait longer, or the food is taking longer, or, you know, that's just one example of many, many that I could come up with here. Here's our quits rate. This is, like I said, something we've been talking about for quite a while, and you know, we saw this number really pick up after the pandemic and recovered, but it continues to move higher, and this is really interesting. So not only the aggregate number of job quits, but the quits rate is continuing to increase. And this is representative of people, you know, again, primarily in that 18 to 34 age group. They're in the marketplace, they're in the labor pool, but they're largely dissatisfied, or increasingly dissatisfied is probably a better way to put it, overall about their job situation. And so they're apt, knowing that there's a large supply of jobs, which we're going to talk about in just a second, that it's easy for them to just quit their job and move on to something else. And this is a really interesting dynamic. This is probably the most awkward and bizarre labor market that I think I've ever seen in my life, or at least since I've been watching these labor markets. But you know, you have more jobs available now than we've had for a long time. You actually, you know, have more jobs available for, you know, every unemployed worker, and that's making it really easy for folks to quit and to transition to something else, including transitioning to even another industry. And this is the chart that really tells that story. And so, you know, you've got two lines here. You've got job openings to new hires, and this is, you know, these are successful hires. And then you've got this black line, which is job openings to the unemployed. And I want to focus on that because what this tells you, if you look at the right-hand column, or right-hand margin, I should say, where this, you know, where this particular data series terminates, you can see that there is essentially 1.2 job openings for every unemployed worker. Think about that. There are more job openings than there are unemployed. So again, this ties back to what I said in the last slide. It's enabling people to quit their jobs, move on. They said, well, I know there's more jobs out there, so I can certainly get another job if I want it. And so this is partially why that quits rate is really, really high, even though the younger cohorts that are really, you know, really a large input into this quits rate, you know, they're in the labor pool, but they're just moving jobs. And like I said, you know, they're also moving industries, maybe moving from food service into logistics, you know, shipping and things like that. But clearly this is I'll say it again, one of the most awkward labor markets I've ever seen, in the sense that you have a considerably high number of job openings to unemployed folks. And if you just take a step back and look at this time series, you can see that we really haven't seen this environment before. It is rather interesting to watch. And you can see this, you know, if you just back away and strip out the ratios and just look at the aggregate data. On the left-hand side, you've got job openings in total. right? And you've got essentially 10.4 million job openings out there. And you can see that if you go back to 2005, like I said, we haven't seen this type of environment before. We've obviously seen kind of a secular rise after the global financial crisis in 2008. And then we had the pandemic, but then we've seen this continued rise, this really sharp rise in job openings. And if you look at the right, it gives you vignettes into two particular areas that are really witnessing a lot of job openings. And these are jobs that, businesses and in many respects, small businesses want to fill, like accommodation, hospitality, food services, transportation, warehousing, utilities, really trying to hire workers here. So this dovetails really, really nicely into some of the National Federation of Independent Business survey data. And so NFIB is really an advocacy group for small businesses. And so they've got really good data from the surveys that we can look at here. And you can see on the left-hand side that the optimism index continues to slide a bit. We saw that pick up quite a bit post-pandemic. We were very optimistic about that. But as this whole labor dynamic has evolved, this very awkward labor dynamic has evolved, you can see optimism has waned. And if you look at the right-hand side, you can see a lot of the reason why. And that's because job openings are really hard to fill. And you see the survey results for this constituent group have really spiked. And so you've got a lot of openings, but they've been really hard to fill. And as a result, you have lower revenue capability, and that means lower earnings, lower owner earnings. As we'll see in a minute, you've got increased labor costs as well. So it's a very strange time for small businesses. I think owners, on balance, if you didn't have the relative inability to hire workers, I don't think you'd see optimism be as sluggish as it is right now. So here's consumer confidence, and we know that that's rolled over. And this time series goes back to 2015, and it's an index. And so what we can see here is the impact of the Delta variant. We saw this number pick up, and in fact, frankly, accelerate especially if you look at the Conference Board number. And it's rolled over because of the Delta variant. I do think we find a bottom close to where we are now, because I think there was a lot of potential apprehension about additional closures and things like that. That it really hasn't manifested, but consumer confidence, is weaker than it was a few months ago. And then on the right-hand side, we've got household spending. And so, we had the snapback, we had this reopening, and then we had a really strong beginning of the year, and then the Delta variant began to kick in, but we were beginning to normalize anyway. And so you can see this nominal level in the black kind of falling into a 10%, level. And so what this means is that household spending on a nominal basis is about 10% above a year ago. And we know spending has been relatively strong. We saw that in the imports number. Demand for goods from overseas is really strong right now. Consumers are spending, even though their confidence may be a little bit off where it was, but they are still spending. And you can see that here in the household spending levels. So obviously what you don't want to see, is a negative number, because household spending accounts for 2/3 at least of our economy. Now, looking at this New York Fed survey of consumer expectations, against the backdrop of spending, so we clearly see in the data that consumers are spending. There is demand out there. It's holding at a really high level relative to a year ago. That's good news. And in this survey, we see that expectations for income growth are increasing heading into next year. So this is 1 year ahead. So as this survey has been updated, you can see that the expectations continue to increase. And so this is good. So oftentimes you'll see consumers spend ahead of earned income. In other words, buy on credit. And in this case, you can see that consumers do expect their incomes to go up. So you would think on balance that this has some positive implications for consumption. Let's transition into just inflation itself. And if you look at this time series going back to 1990, and this is from the Bureau of Economic Analysis and reported to us, a chart developed by FS Investments, you can see the personal consumption expenditures, or the PCE deflator as it's known. This is the measure of inflation that the Fed is most concerned with. And you can see it spike here in 2021. You can see that this data series over time, the secular inflation has declined somewhat. 1990 obviously was a surrounded or encompassed a recession period, in which we saw higher energy prices and even core prices were higher. But that's come down over time, and then just here recently, and especially in the orange line, which represents the food, backing out food and energy, which you can clearly see here, contributes to increased volatility of this time series. But core personal consumption expenditures have really spiked here lately. Here's a quick look on two elements that help to foster this inflation. We've got goods-related inflation. Again, demand has been strong, consumption's been strong, and the availability of components, the cost of shipping, and even now the cost of labor is causing prices or inflation within the goods sector to increase. And we're also seeing that in the services sector, driven now primarily because of an increase in labor costs. Now, as you dovetail that into what you see on the right-hand side, there's clearly in the 2020 cycle, this is showing you 2007 and 2020 only to compare one recession to the most recent recession, that being the global financial crisis. And, we saw wages and salaries in 2007 just kind of meander and not really regain their prior level for, basically 3 years after the start of the recession. Whereas, if you look at the 2020 recession, again, pandemic induced, kind of almost artificial, such a fast and rapid recession and recovery that it's almost kind of hard to even believe it was a recession. But you can see wages here in the current cycle have really gone up. And I think that those types of pressures in the system can be rather sticky. Well, going back to our NFIB data, these things are really telling too. So again, you've got expectations for pricing going up. You've got cost inputs and expectations for costs going up for small businesses, and also, and you can see that here, that compensation is expected to increase. So this is a survey of small business owners that say, on balance, that compensation is moving higher as we head into 2022. And also, as you see on the right side of this, that labor, the cost of labor is their single biggest issue right now. Well, as we continue to look at inflation, we'll look here at CPI. We just got through looking at PCE, but the Consumer Price Index here was up 0.2% in the September survey. That was in line with expectations. You can see kind of on a month-over-month, rolling monthly basis, we're not posting the high numbers that we were earlier this year, but they're still, meaningful post-pandemic. You can see the median consumer price index here on the right-hand side, and this is looking at this is the all-in CPI, not core, but it's showing you basically relative to a year ago, we have spiked, but we're not quite to the levels that we were before the pandemic, at least not yet. Now, if we look at the core CPI data and we decompose that, which is what is shown here on the left-hand side. The data comes to us from the Bureau of Labor Statistics, so we can kind of delve into that. You can see here that the spike in inflation that we've seen, at least here lately, has had a lot to do with owner's equivalent rent, which is kind of that kind of pinkish bar. Now, earlier in the year, it was used vehicle prices, it was lodging, it was some other things, and we've seen a little bit of a moderation in that, but rent is now coming up to the surface. And we knew that rent would be a greater component of inflation, and because rents typically lag home prices, and we've seen such a dramatic increase in home prices that we knew rents were following at some point, and they are now. So we can see that here on the right-hand side, which is the weighted average owner's equivalent rents month over month that has it's shown some strength earlier in this year, and it's picking up steam right now, and we expect this to continue to be a theme heading into 2022. Now, if we look at some other components of CPI month over month, food at home. So the September reading was 1.2%. As you can see here, at least this time series takes us back pre-pandemic. You can see that food inflation is still important and has become a little bit more relevant in terms of the overall cost basket for households. Now, on the right-hand side, here's something else that's also important to households, and that's the cost of gasoline. And we've seen a host of reasons why crude prices are higher, and as a result, crack spreads have been altered, and so we have higher distillate prices, including gasoline here. So as input costs go up, you would expect that gasoline prices would follow suit. I do think that, at least from an energy basket standpoint, we'll have much higher production levels next year, and I wouldn't expect gasoline to be as much of an influence, because I do think crude prices are likely going to hold or even decline a little bit from where they are right now. But needless to say, gasoline and food are important to households right now because they're paying more for them. So something else that we're going to monitor over the holiday season and through the winter is residential electricity prices, something that I happen to note from the EIA, which is the U.S. Energy Information Administration, and it's part of their energy outlook. And you can see here that the forecast for both 2021 on balance and then 2022 is for higher overall electricity prices. And so again, something else for households to be considerate of, even if households are expecting to have more income and also expecting to continue to consume. Now, households, reflective of all of these input costs and whatnot, they on balance are beginning to feel that inflation over the next 1 and 3 years is going to pick up meaningfully. And you can see that here in this New York Fed survey, and this is, again, their monthly survey of consumer expectations, and you can see here that the inflation basket, or at least expectations within that inflation basket, have really continued to move higher for several months now, but they've kind of accelerated as of late because of, I think, in response to and concurrent with some of these higher inflation prints that we've seen here in 2021. Certainly, some of the really high prints that we saw several months ago were influential in this blue bar really spiking in the first half of the year, and we can definitely see that those numbers are continuing to trend higher. So households, while they expect more income, expect to consume, certainly recognize they're paying more for food and energy and for gasoline. Their expectations for inflation looking ahead have definitely picked up. Now, switching to business surveys and business sentiment, this is the Purchasing Managers Index business survey, and I thought it was important to include kind of a global view. And this particular chart has not only China and the U.S. China's in orange, U.S. is in black, and then that gray bar represents the kind of the sum total of developed markets. And you can see that business surveys have rolled over a little bit from May, which kind of serves as the peak for this interim cycle. Time series goes back really to that point just at the edge of the advent or the onset of the pandemic here. But, having said that, at least the U.S. and the developed markets are above 50. And why is that important? Because this is a diffusion index. And so everything Above 50 represents expansion. Everything below 50 represents contraction. And you can see here, China now is officially in contraction from a PMI standpoint. A lot of that has had to do with closures related to the virus, et cetera. But you can still see here, you know, the U.S. and developed markets are still holding in about 55 or so, which, you know, is not as robust as they had been, but it's still in expansion mode. And so as we look at producer prices, and we just spent some time looking at consumer prices and some of the inputs into the household, you know, now we're kind of shifting gears in looking at producer prices. Now, we know that prices remain high, but at least in the latest data reading, you know, where the expectations were 0.5% just in 1 month alone, we only got 0.2%. So this is maybe a little bit better than we expected, but you can see the cluster of those large increases there in 2021. That's still indicative of an environment where producer input costs are still really high, but at least this latest data point wasn't that bad. Now, as we look at commodities and look at other things that are relevant for producers, obviously the commodity spot index continues to be high. We've had some moderation in some areas, and we're certainly not at peak in a lot of areas. But if you take the whole basket of industrial commodities, soft commodities like agricultural commodities, and then put these all together, I mean, this basket, the index here is really has really taken off in 2021. One evidence of that is in the metals index, and so these are representative of the a lot of these industrial metals, and this is the London Metal Exchange, and you can see that metal prices are moving higher. All right, now we're going to move into the investment markets, and I haven't shown this chart in a while, but it just this is Bitcoin, and you can see the volatility that's incumbent with this, and this is just really a look from the beginning of the year, and you can see just the roller coaster ride that you have with Bitcoin. There's a lot of things to talk about here, to reflect on, why Bitcoin isn't really set to be any kind of a method of a standard bearer for a currency. A lot of confusion over what Bitcoin represents right now. A lot of it has to do with the volatility and the fact that we've got a gazillion cryptocurrencies, Bitcoin simply being just one of them. But needless to say, we have seen a rather dramatic recovery in just a short period of time in the price of Bitcoin, and now we're back up to almost $60,000 per Bitcoin. Here's the S&P 500. So we know we've had some volatility lately in the S&P. I don't think that's necessarily bad. We hadn't had a point-to-point 5% drawdown in the market in a long time, and it was really overdue. And we had that. And I think it's healthy. As we look here on our 50-day moving average, we have had a recovery of sorts here over the last week or so, and so we've seen that kind of bump back up against the 50-day moving average. So from a technical standpoint, that's actually a positive sign, and I do think that we're going to be seeing a few more, a little bit more market action that looks like the right side of this chart, but still with an upward bias over the next year. I just think it's less linear. It looks a little bit less than it, or I think it will look a little bit less than what we see here in the left most 2/3 of this chart, and a little bit more like what we see in the right-hand side, but with an upward bias. Well, with this correction, we've actually seen forward price to earnings ratios go down. And so this is just, indicative of where the market is in terms of its valuation, not its aggregate level, which we saw in the last chart. But this has actually been something that's played out for, several quarters now, in the sense that earnings have gone up more significantly than prices have. Even though prices have moved higher, what we've seen is that the PE ratio or the valuation in the market actually go down. So this gives me a little bit more comfort, despite the fact that even at 20 times forward earnings, the market is still above its long-term trend lines, and certainly where it was kind of looking before the pandemic, that it still provides feedstock for further price action to the upside in the equity markets. And something that I've been talking about for a while continues to play out with a vengeance. Not to steal the term here from Goldman Sachs, which is reported in this article from the Financial Times, but share buybacks continue apace, and companies have had strong earnings, strong cash flow, and they've been putting that money back into the market by virtue of share repurchases. So you can see here that we have had some years that have been exceptionally strong. This data series goes back to 2000, but here over the last year, certainly relative to 2020, a year in which a lot of companies really curbed their repurchases, that it's come back really strong this year. And something else I thought was interesting on the right-hand side relative to the U.S. markets, and particularly the S&P 500 here, is that based on a trailing 12 months earnings, the earnings contribution from the top 10 companies in this 500 constituent index is really increased. So what this chart really tells you is that essentially 30% of the earnings in the S&P 500 have come from the top 10 firms in that index, like an Apple, etc. And so, you'd like to see a little bit more breadth in the market than we do now. This is certainly an interesting development as it's kind of taken hold. It tells you that, or it implies rather, that perhaps looking ahead that we might have more influence in market behavior driven by these largest firms. And again, the S&P 500 is a market cap weighted index, which means that the index is inherently more influenced by the largest capitalization firms that are in the index. As you can see here, obviously those companies now are generating a disproportionate share of the earnings for the index. And then looking at U.S. valuations relative to those across the world, I've been making the argument that international markets are much more have much better value, and this is a chart that kind of shows that. So the Stoxx 600 is the Euro Stoxx index, and so this is just kind of a proxy for the international markets, but it really focuses on Europe. You can see that even though the U.S. market, as we just saw in the prior chart, that multiples, price to earnings multiples, are around 20 times. If we look at the European multiples, those are really about 15, and they're both heading down. So while you may not have the same catalysts, the same drivers overseas that you do in the U.S., you certainly have better valuations overseas, and this is an argument to diversify somewhat your holdings overseas. Now you're going to have different return patterns. You're going to have different earnings patterns from looking at the international markets and European markets in particular relative to the U.S. market, but at least you have better valuations. All right, switching to bonds here, we've got a lot of activity going on in the fixed income markets, and a lot of this is driven by kind of expectations of what the Fed's going to do, when they're going to begin to taper or curtail their asset purchases, and when they're going to eventually start to raise interest rates. And this is all coming against the backdrop of what we've been talking about through much of this broadcast, which is the inflation profile. The expectations, both current realized prices are higher and expectations are moving higher. And what that's doing, and I'll start with the right-hand side, is it's driving kind of shorter term yields higher, even though near term and cash yields aren't moving higher because the Fed has said, hey, we're not going to be raising rates for a while still. When you get into the 2 to 5 year part of the maturity spectrum, it begins to get more influenced by what the 3, 5, and 10-year inflation expectations are looking like. And we know that those are going up. And as a result, we're seeing an increase in the 2-year yield up here, as you can see here, about 36, 37 basis points. And what that's doing is it's flattening the yield curve. So the 10-year, the 2-year spread is now gone down a bit. You can see it's back down to levels that we saw back in at the end of last month. Again, it's not necessarily a concern to me per se, but it's just something that we want to monitor. And we know that interest rates are going to likely to move higher. That's really a good thing because it's indicative of more normalization in yield, so we haven't seen for a long time. So I don't worry about it, but I certainly monitor it. And as the bond market is very apt to do, it's very good at anticipating future economic trends. And this is one. So this is, what they call an inflation swap rate over 5 years. And it really, without getting into a lot of technical definitions and jargon, I'll just say that it's a really good proxy for what the bond market itself is expecting inflation to look like over the next 5 years. And you can see here that number looks like about 2.6. We picked up a little bit of steam here in the last month or so. You can see that, this number was about this level back in 2017. Again, if you look at, maybe 80, 90 years worth of inflation data, the average is really about 3, even though over the last 20 to 30 years, that inflation rate's been a little bit lower. And in fact, I'd say 2.6% is very consistent kind of with what we've seen over a longer interim period, like maybe those 20 to 30 years. So we've had that secular decline in inflation, even if it represents a pickup from where we've been maybe over the last 5 to 10 years. Well, something that comes with the discussion on inflation and interest rates is, what are the real rates and what is a real rate of interest? And it really represents kind of this nominal rate that you see in the papers and you see announced in the financial press, but it takes that rate and subtracts inflation. And we know inflation is higher right now. And so what that's done, even if we haven't seen a really significant rise in interest rates, if you subtract out the higher inflation that we're seeing, that means that our real rates are much, much lower than they've been. And this is a slide from a research report from Bank Credit Analyst, or BKA. And it really does a phenomenal job looking back to 1980 on this secular decline in interest rates. Rates kind of peaked in 82, 83. And they've been in decline ever since. And real rates in particular have also been in decline. And you can see that this latest data point is a significantly negative number just because rates are so low and the Fed is really holding down rates by virtue of their intent to keep short-term rates close to zero for a while. that you're seeing really, really negative rates overall right now. Well, in our last few slides, one thing I wanted to do was kind of bring us up to speed on what the private capital markets are doing. And we know, and we've been talking about at length, the issue of lots of liquidity in the market, and that continues to be the case. And so as a result, you've got a lot of money trying to find deals, trying to chase deals. You've got a lot of private capital firms and private equity firms out there that are looking for deals and raising funds and all of that. And so you can see here year to date in that light blue or light gray, if you will, you can see a really big spike relative to last year. and in terms of deals, and we know year to date we're having almost a record year. And on the right hand side in that blue line, you can see that valuations for the money that's being applied to these deals has really gone up. So, you know, what this kind of tells you, and kind of condensing all of this information here on this slide, is that the private equity market is really robust. There's a lot of money flowing into a lot of institutional fund, like insurance companies, and even large individuals and fund of funds are putting a lot of money into private capital now that are going out and trying to find businesses to acquire, and they're paying a lot more for those businesses now than they were even a year ago, and those valuations are moving higher. If you go and switch gears a little bit, look at hedge funds, which in traditional sense have probably played a little bit more in the conventional publicly traded markets. You can see that hedge funds are now making a lot more investments in private companies, and so there's a lot of things at play here, and one of which could very well be the fact that maybe valuations are a little bit richer in the publicly traded equity markets, and so hedge funds, along with private equity, are finding much more value in the private markets in owning operating businesses and things like that. I do think that this is a trend that will continue to take hold. Not only in this slide, but the one prior, is that you do see a lot of liquidity in the market. We know the Federal Reserve is going to start pulling away the punch bowl at some point, but even when they do, there's still going to be a lot of liquidity in the market. And when you think about this, you've got the Fed that's injecting a lot of liquidity in the market, and all they're really talking about now is at some point, maybe beginning of next year, that they're going to begin to slow the pace of those injections into the market. Now they're not at all saying that they're going to take that punch bowl away, but they're just kind of tugging at it a little bit to get it away from us. But there's still going to be a lot of liquidity in the market. I still think private equity is going to be very interested in the private markets. I do think hedge funds are going to continue to be very interested in the private markets, and I really don't see that changing much. All right, and we're going to really end on this slide, and it's just kind of looking ahead as we are now moving headlong into the holiday season here in the coming weeks. We get our time change, and people are going to be focused on holiday shopping and et cetera, et cetera, et cetera. Here you can see 2021 expectations for consumers is that they're going to be spending more on the holidays. Again, more than last year, but last year was somewhat depressed, even if consumer spending overall was pretty strong. But if you look over the pre-pandemic years, really 2015 through 2019, what we're expecting here in 2021 is actually pretty strong. So we're going to have to spend some time watching this, and amidst this inflation pressure and this inflation expectation, realized prices and so on and so forth. This is going to be a real interesting dynamic if the consumer is going to continue to plow through with increased consumption at a time where inflated prices are maybe a little bit inflated, and maybe consumption might be a little constrained a little bit by increased gas prices and utility prices and things like that. So if we're able to punch through with this number that is reflected in this Price Waterhouse expectation against the backdrop that we've been describing over the last 40 minutes or so, that would be a really good thing. That'll do it for this week. We have a little bit more charts in this week than we had. We had to get caught up on a few things, especially on the inflation front and also on the markets front. But I hope you've enjoyed the presentation on behalf of the entire team. I hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye-bye.